G'day expats, ladies and gentlemen. Welcome to another episode of Expat Chat, episode 158. Today I'm joined with my guest co-host, Martin Jack, who is one of our specialist financial planners here in the Gold Coast office with me, focusing on the APAC region. Good morning, Martin. How are you?
Morning, James. I'm doing really well, thanks. Thanks for having me back on, mate.
Now, we've got you on. Brett's a little bit busy the next couple of days, moving some things around. So Martin has stepped up. Martin, we've had you on before. I feel like whenever we're having you on, it's another Q&A session from our expat Facebook group. We've got some good questions to run through today that I want to sort of throw at you, put you in the hot seat and get your opinion on some things as well. So for our listeners, these are real world questions, real world tips and guidance that you can draw from that. But I guess to keep the compliance lawyers of the world happy, anything that you hear today should not be construed as personal financial advice or tax advice. It doesn't take into consideration your personal objectives, situational goals. It should only be consumed for entertainment or information purposes only. If you do need advice, please be sure to reach out to an accredited, qualified tax accountant, tax financial advisor like us, or any relevant lawyer and those sort of things. Anyway, mate, let's jump into it. Let's tackle these questions. We've got a few from the group. We won't get through all of them. I actually listed out about 20, but I think if we did that would be here for the next 2 to 3 hours, the way you and I talk about these sort of things. So we'll
Probably
just
stuck on the first one.
yeah, that's right. So we'll just jump into a couple. We'll jump into the first one. Going to throw it over to you. This first one, why are Australian, sorry, mate, not what that one. We'll get to that one. First question here. What's the biggest financial mistake you see Australian expats make when they first move overseas? It's a lovely broad question, but want to get your
Oh,
opinion.
that's a big one. Yeah, I mean, you could go down a whole lot of different avenues there. You could look into the asset classes, obviously, property mistakes that occur, share mistakes that occur. Um, I would say not being properly prepared, not being prepared before you leave, because you can't turn back the clock. There's certainly a lot of things that can be done retrospectively. So after you move overseas, things like deemed disposal, you have time until you file your tax return to do that. But there's things if you wanted to sell property, you can't, or there's extra considerations and complications if you move overseas and now you're a non-tax resident, because it's a whole lot harder to declare yourself a non-tax resident, shoot back and, say, oh, I'm an Australian tax resident to fix the one, two, three, four things that you should have done before you leave.
Mm.
And that's just going to raise a whole lot of flags. So now tax residency really starts to come into the picture, especially if you just dip back overseas after you finish winding up and, comes down to your intentions, obviously. So definitely, preparation. So, I often hop on calls with clients and expats before they become a client as well. And sometimes it's 2, 3. I've got clients who aren't moving overseas for 5 years, and
Mm.
that's just because they see the value in having someone in their corner who's watching over the legislation on the international side and the country in which they're intending to move to, and knowing if they need to make changes to their situation beforehand, whether that's the Thailand remittance tax
Mm.
that got introduced a few years ago, and even legislation changes around property or shares or deemed disposal or residency. So those clients, they've got us in their corner and they're well and truly prepared, 5 years out, and we just do normal Australian tax residency strategies. But it really, gets to the nuts and bolts when we get closer to that time frame. But yeah, as I mentioned, can't turn back the clock. So the more time you have, the more time on your side before you leave, the more time you have to prepare and actually build out a bit of a strategy and a expatriation plan so that when you're a month out from leaving, you're not in a frantic rush to do one, two, three, four things that you're waiting on hold to the ATO or your insurance provider or whatever it might be. You've done that months ago, and you're just waiting for to move out of your home and to jump on that one-way flight.
Absolutely. And I mean, you mentioned about obviously, yeah, preparing before you go. I mean, when you look at our clients, do you think there's like a perfect time frame in which they should be speaking to a professional in preparation for their upcoming expat stint? Would you say it's 12 months? Would you say it's a couple of years? Or I guess it depends on their
Mm,
situation.
yeah. that last comment there. So it depends on their situation. Absolutely. I feel like that's always the comment that we would throw around. But I would like 12 months for a client to engage me. We can start to build out a plan for 12 months. Whenever someone comes to me 3 months before they leave, it's a little bit of a, oh crap, let's make sure we really look at this one, because I don't know what I don't know until I start reviewing your situation, and I might uncover something. And if you think about properties as an example, just because it's such an easy telltale when we move overseas and the implications of selling that as a non-tax resident. If you sell your property a week or a month before you move overseas, as an example, and then you have a 60-day settlement, so it settles after you become a non-tax resident. But during that time frame, you left overseas and you became a non-tax resident, and that property contract falls through. Well, now you haven't sold your property and you're a non-tax resident. You deemed yourself a non-tax resident. Your intentions show that you've headed overseas. So there's a huge risk there with trying to make everything happen in that last few months or that last few days and weeks as well. So you'd be stuck in this position where I either am a non-tax resident selling this property now and I don't get that main residence exemption, as an example. So yeah, time frame, I'd like 12 months as sort of the goal for me personally, for my clients, just because it gives us a lot of time ahead of us to plan and educate, and then allow them to make informed decisions with their personal side and with their job. And even when it comes to things like job negotiations, if they know it's on the horizon, we can jump on a call and we can say, hey, they're not offering you any 401k matching. You should ask for that. Or, hey, they're offering 1, 2, 3. You don't need that. And we can have those sort of discussions earlier.
Yeah, absolutely. Well answered. Well answered. Yeah, it's a good question. There's such a broad one as well. I think we could probably list all up probably about 30 or 40 mistakes that we've come across in a big fat list. Maybe we'll save that for another episode of just the mistake episode. Another good one here, another good question for you, mate. So why are Australian managed funds, ETFs, and listed investment companies generally unsuitable for clients who become US tax residents? It's asked here, what is the main US tax form triggered by these investments? I mean, we don't need to go into the form if we don't want to, but what's the issue with these kind of investments when you're moving and living in the United States?
Yeah, I mean, this is the one that I refer to as the gotcha tax, and it would form under one of the big mistakes that we see when people leave Australia. And what that question is referring to is passive foreign investment companies. So PFIC is the sort of acronym there. Essentially, that's any exchange-traded fund, any managed fund. It's any listed investment company that is foreign to the US, so it's domiciled outside of the US. Now, the technical definition of a PFIC, unfortunately, it casts a really, really wide net and a really broad net, because it's really built to stop people from sheltering wealth outside of the US and hiding wealth away from the IRS. And because of the broad definition of a PFIC, those individual ETFs and managed funds and listed investment companies that might be traded on the Australian Stock Exchange fall into its catch-up. Now, it's a gotcha tax in my sense, because Aussies would move overseas, and Aussies love the ASX 200 and Vanguard ETFs, as an example, on domiciled here in Australia. They move overseas, they file their first tax return, and they get stabbed with this massive tax bill, from accounting fees to paying tax on potential unrealized gains as well. So yeah, I sort of mentioned it there, but the big risk for this is the IRS basically has a separate form for each individual PFIC that you have. And it's a very lengthy form that most US accountants will charge anywhere from sort of $250 to $500 USD to file each individual PFIC. So if you've got a portfolio of PFICs and they're charging $500 per PFIC, well, now you're obviously facing a very large accounting bill. But then to add on top of that, you have this impact on how you report it and how the taxation applies on these foreign funds. Because it's foreign to the US, the IRS, they can't capture that. It's not domiciled in the US. They have less control. So essentially what they make you do is at the end of the 12-month period, they make you have an election. And the common one is a mark-to-mark election, basically, where you have to declare the total unrealized gains that you've made on that investment and on each individual PFIC. You then pay taxes on those unrealized gains at the highest US marginal tax rate, which could be very, very nasty. But then secondly to that, you're declaring these unearned income that you haven't even realized and put into your bank account yet. So really, really nasty. And that's definitely
Mm.
what that's alluding to. And, there's certainly ways you can get around that, that's for sure. But, it does catch a lot of Aussies out when they move to the US.
Yeah, absolutely. And you answered it so well there. And I think a lot of clients that are in Australia right now and might have been moving overseas or have lived overseas before, if they've previously engaged in another financial planner, it is very common for, I'd say, a lot of traditional financial planners in Australia to use managed funds, ETFs within their recommended portfolios, whether it's in super, whether it's an investment or other types of structures. But they are your kryptonite when you head over to the US, and that's when you need to think outside the box, use direct shares, use US domicile, listed investments, get creative with your fixed interest and property exposure. I know we've spent a lot of time designing our portfolios and developing our own investment thesis, and it's great. We've got our own sort of SMAs that clients tap into now, which is great, supported by the investment committee. But it can be an absolute minefield when you head over there. So yeah, a really good question there, and yeah, some practical steps to take when you have that already in your portfolio when you get over there. Another question here. Um, when are restricted stock units typically taxed in the US, and at what rate is withholding tax commonly applied? What risk does this create for high income earners? So I might get you to probably tell the audience and our listeners what are actually restricted stock units.
Yeah, yeah. Well, restricted stock units are typically employer stock. So if you work for a public company, as an example, like Google or Microsoft, part of the remuneration that you might receive is in the form of the company's stock, and it's restricted because it will only become available to you after certain requirements have been met. And typically, this is a time-based thing, and they call it the golden handcuffs because you'll sign up for an employer and they'll say, great, we're going to give you 50% of your wage as your bonus as restricted stock units, so company stock, but it's restricted until you've been here for a certain amount of time. So that's what we call it's being granted to you. And then they vest over multiple years or multiple quarters. And that's very dependent on the individual company and sort of your own remuneration setup that you have with your employer. But most commonly, you are granted when you start employment or from, you receive a bonus, a certain amount of stock. That stock will vest on an annual basis over typically, a 4-year trailing period. And then every single year you might get granted a bit more. And then obviously you have to wait longer and longer and longer to receive those final vests. And that's why the golden handcuffs, and they keep you there.
Mm. Yep, absolutely. And
Yeah.
I mean, I think RSUs are really interesting the way they are taxed. In Australia, like there's a similar system, and sometimes a little bit different, but yeah, I think it's interesting, and I think this question is really interesting because I literally had this question this morning from a client email in that's in the US where they might be exiting their job very shortly from a tech company. I will not name names. And they are wondering, oh, do I sell this batch of RSUs that are about to vest, or should I just hold on to them? I know there'll be some tax withheld, but because I'm going to have a sabbatical in the new calendar year coming 2026, should I sell them then? Because I'm not going to have too much of an income in the US. So any capital gains will be taxed, very small compared to the high income that she's on this calendar year. So that's like an example of some of the, I suppose, ad hoc advice that we're giving our clients. She asked the question,
Mm.
I was able to answer it very cleanly. I even assessed and looked up the company and see how the valuation's going relative to the market and the S&P 500 index and where it's at. And so a lot of that goes into the advice that I provided to her back on that email to make an informed decision. But RSUs, they're really common in the US, really common.
Yeah, I think just to go back to the original question there to the whoever wrote that question, your answer is they tax at vest, and there's a federal withholding tax rate of 22% typically applied. And then where that catches high income earners is because a withholding tax is not the final tax. That's just a withholding amount. That's typically the mandatory amount. So if you receive these RSU or these RSUs vest to you, and there's 22% withholding tax applied, and then you decide your beauty, I'm going to sell that down, I'm going to use it to upgrade my home, or I'm going to put it into a portfolio somewhere else, but you're a high income earner, well, your tax rate might be above 22%. which means that there's a shortfall there. So when you actually go to file your tax return, if it's within the first year, naturally, you would have to apply that extra taxes or the shortfall there to your marginal tax rate over in the US there or whatever country you reside in, depending on their jurisdiction. And I say the US just because that's where this is commonly placed and when we're dealing with taxation in the US. So there is that difference there. You can typically opt in for a sell to cover option where your employer will work out what that difference is or what that delta is, and then they'll sell an additional amount of your existing shares or the amount that is vesting to cover the extra amount. But that's something that you'd have to work out with your employer. So you can get these surprise tax bills when you have all of these shares vesting, thinking that you've already paid this federal withholding tax rate, or you've already paid tax on those shares. Or RSUs, but then you have to pay the difference, especially if you're in places like California where they have state tax that obviously applies on top of that. So you might be looking closer to 40 to 50% actual tax for a high income earner, but you've only had 22% withheld. So that could be a big difference if you already spent that money.
Yeah, absolutely, absolutely. So good question there. Next question here, property. So is it better to keep property in Australia while I'm away, or sell and invest elsewhere? Over to you.
Yep. I get asked this one a lot, actually, because Aussies love property, and when they move
We do.
overseas, they go, "Oh, great." Absolutely.
Yeah.
They think, "Well, what do I do? Do I hold on to it?" And maybe they've listened to our podcast or read some articles or spoken to some accountants, and they start to understand the tax treatment of property as a non-tax resident. So to give a quick recap, there's three core considerations. So the first one is you don't get the 50% capital gains tax discount for any period of ownership as a non-tax resident after May 8th, 2012, when that was removed for non-tax residents. The second one is if it's a principal place of residence now and you choose to sell it as a non-tax resident, you don't get the main residence exemption if it's sold as a non-tax resident. If you come back to Australia, you're a tax resident again, you're entitled to the main residence exemption only for the time that it was treated as your main residence, and then potentially you get that 6-year temporary absence rule as well. The third consideration, though, and more so in terms of if you use it as an investment, is the income that's derived from that property. As long as it's positively geared, it's taxable first and foremost in Australia at non-resident tax rates because you're a non-tax resident, which means that it's 30% on the very first dollar up to 135,000, and then it goes up to 45% beyond that. So when we have a good understanding of, I suppose, the negative considerations of property as an expat, then we have to overlay that with your own personal circumstances. Is it good to hold? Is it good to sell? If you're moving overseas for 3 years and you're going to be a non-tax resident for 3 years, you want to keep your principal place of residence. Well, we know that we move it overseas, we turn it into an investment property. If we move back to Australia within a 6-year window, well, we're most likely entitled to that 6-year temporary absence rule. So all of the negative considerations with owning investment properties, it's essentially washed out because I'm coming back to Australia at that sort of within that 6-year window. I don't have to pay any capital gains tax. But if we're spending 10 years overseas, this is where it really starts to come into play, or even 5 years, because you don't get that 50% capital gains tax discount. And what that means is if that property is valued at $1 million when you leave, and the Australian property market does what the Australian property market does, and it might double within that sort of 7 to 10 year window. Well, now you've got $1 million of capital gains. If you sell that as a non-tax resident, where you pay the full capital gains tax on all of the growth there, that full $1 million, and then that non-resident tax rates as well. So if you look at our tax rates, we get very quickly up to the 45%. So the adjusted or effective marginal tax rate is probably somewhere around that sort of 40% rate. So about $400,000 of that $1 million paper gain that you've now realized has gone to the taxman, which obviously is huge. So the decision on buy, sell, retain, I think it really comes down to your time frame overseas and then also the opportunity cost. Because if you've got no debt attached to that property, and we know that, well, if I'm overseas for 10 years or 5 years, I get no leverage. So now it's comparing property to other investment assets. If I just sold that down before I left, paid no taxes under the main residence exemption, I've came into, let's say, $1 million of cash. I can put that into a portfolio of shares after I leave Australia. That way the shares grow completely capital gains tax exempt. They grow. I come back to Australia, deemed acquisition event occurs, now I've got this $2 million share portfolio that I can go and rebuy my property that I wanted to and not have to take the haircut of a 45% tax rate on everything over 190,000. So yeah, it really comes down to timeframes for me.
Yeah, absolutely. I think there's not too much I can add to that as well. I mean, I love the fact that you can obviously use property in Australia, regardless of being a non-resident, and gear it, get a loan on it. You can then pull the equity out, go again, buy another one. And if you're doing that over a 15, 20, 25-year period, that's how you do build real wealth. Like that's obviously a proven formula in Australia. It's just not the most tax effective tool to do it back in Australia because of the concessions that Martin just mentioned. So yeah, I think it's dependent on the situation, absolutely. But God, yeah, there's so much in that as well that we could really
Mm,
unpack. But good
yeah.
question. Great question from the expat group there. So last one for today, because we're dragging on. God, we're doing well. What's the best way to plan for retirement if I'm not sure which country I'll settle in? God, we get this one a lot, don't we? What's
Yeah.
the best way to plan for retirement if I'm not sure which country I'll settle in? What are your thoughts?
Yeah, if any of my clients are listening to this, you know that I always ask you this question, or at least on the first few meetings that we have, one of the first questions I ask is, where do you intend to retire? And I'd say most people that I speak to would say, I don't know, because you get a taste for the expat lifestyle and then you live the expat lifestyle and you go from Singapore to the US to Europe to Dubai, and you shop around and you start to really enjoy that. So then you would have these own emotional ties and even friends and family in different countries around the world. So sometimes the answer is, I don't know. And that can be tough because, our philosophy at Atlas is always, should be building the wealth in the country in which you intend to retire to, typically speaking for most of our clients. So
Mm,
when you don't know where you intend to retire, I try to really sit down and narrow that down with my clients and get them to think about it. But if you can narrow it down to two or even three countries, then we can start to build a bit of a plan. So let's say that you wanted to retire in the US and then also here in Australia, 6 months, or a couple years, couple years. My approach would be to split your assets evenly between the two. And when you're in the US, you can build your wealth. You can draw down from your US assets, whether that's the pension account that you have, so your 401k account, your social security entitlements, your Roth, your IRA, whatever it might be, that you might not necessarily want to withdraw anyway because of the tax implications.
mm,
That's going to give you that local tax protection, so tax legislation protection and local currency protection as well. So you're not transferring across regardless of the FX markets. Then you come back to Australia. Now I'm an Australian tax resident, or I'm here in Australia spending AUD. Well, we've got AUD assets to start to draw down from at that stage as well. So that might be superannuation, that might be your investment account, property income, whatever it might actually be. So having that even split will give you the most flexibility. And when you decide to pull the trigger on, you know what, I love the sunny beaches of the Gold Coast and I'm so over, New York City, then you can decide to send all your money back and repatriate those funds and move it into different vehicles back here in Australia. But having those even splits between the countries that you're most likely going to return to is one way that you can manage the two biggest risks, which is tax legislation change risk and currency risk as well.
yep. I think currency risk, God, we talk about it so much with our clients because it really is just one of the biggest threats to retirement and retirement planning. And as you put it, having some sort of focus and in mind when it comes to where you might retire is really important because you're always going to be exposed to currency. And the scariest thing when we look back the last 20, 30 years of the US dollar relative to the Australian dollar, it's been times where it has been on parity, which means that if you returned back to Australia when it had been on parity, you would have lost 20, 30, 40% of your wealth at that point in time and what it's worth. So it does make, yeah, it's crucial planning that out
Mm,
when it comes to retirement planning. Well said. I think we'll leave it there. That was probably a really good question to finish on. Obviously, some real food for thought for our listeners. A bit of a call to action for our listeners as well. We've got some upcoming events later in the month. If you are in the Middle East, especially if you're in the UAE, We've got our masterclass being put on 22nd of October in Dubai, and then the 23rd of October as well. If you go to our events page and register there, you'll be able to see where and when it's on. Lastly, next month we'll be doing some webinars as well, so keep an eye on the socials. We'll be mentioning those. Those will also be a bit of a masterclass update, but also mainly updates around the equity market, property, the economy, all those things for our audience and our clients. That's all it is for today, Martin. Really appreciate you coming on today and sharing your insights. Can't wait to have you on another episode, and we'll see when Brett is back on deck. Thanks for your time.
Sounds good, mate. Thanks for having me.